All right, welcome back. I've been doing this for a while now, and you know what? Something doesn't feel quite right to me, right? Stocks are breaking records to the upside virtually every day. And we have an unemployment rate of 4.3%. And when I was in school, 5% was technically called full employment. GDP growth, that too has been coming in at a stonking 3.8%. And last quarter, corporate earnings have been coming in pretty good too. So why in the world are we cutting interest rates, right? Are the jobs numbers really that scary with an unemployment rate of 4.3%? We've seemed to all but abandon this idea of that 2% inflation call. Today we sit at 2.9%. And let's call that 3%. And the Fed is still on course for another 2 rate cuts this year. Now, I thought we'd take some time for our next guest to make his case as to why we should be seeing more upside in these stock prices. Please welcome to the show Mr. Eddie Ghabour. Eddie, thanks for being on. He's a co-founder of the Key Advisors Group in Lewis, Delaware. Appreciate your time today. I know you're busy. The markets have been kind of crazy already here today, Eddie.
They have.
What are your thoughts? I mean, again, a lot of good things out there, but at the same time, we're cutting rates. Why?
I think the reason why we're cutting rates is 2 reasons. Number one is I think the Fed has finally recognized that this economy is structurally not going to get to 2% without some type of collapse economically. And so now that they see the labor market starting to show some weakness, I think they're picking saving the labor market, or what they perceive as saving the labor market, from getting much worse over the potential inflation issue that this is going to ultimately cause sometime probably in the next 12 months. But at the end of the day, the reason why we continue to think that stocks will continue to go much higher than anticipated is because of that liquidity. The liquidity that they're putting into the system, whether we agree with it or not, or they need to be doing it or not, really doesn't matter. What matters is they're actually doing it. And when you flood the market with debt, like we're doing, with rate cuts, and this is happening around the globe. Look at Japan and their market reaction yesterday. This is a money printing environment around the globe with no end in sight in the near term. It's going to end very badly, but the last major leg of this bull run, like all bubbles, will take us to levels that even we don't know from how high it's going to go. But I believe it's potentially substantially higher because it's unprecedented for them to be doing this collectively around the globe at a time when the economy is fine. The labor market has cracked, but it's fine. There's a big difference between a crack and a recession. And so they're going to cause bigger problems down the road. But I'm not going to fight this historic trend that you might not see again in the next 30 years. So this is the 1990 internet bubble, but it's on steroids, and it's going to be bigger than that bubble. And you can make a lot of money in bubbles, but you have to know when to get out. And when that time comes, we'll worry about it. But for now, the trend is your friend, and the Fed is flooding the market. And President Trump's next appointee in the Fed will probably be the most dovish of our lifetime as well, too. So they're going to get those rates down one way or another, and it's just going to be bullish for the equity markets.
Yeah, I mean, that's hard to argue with that, and it makes me nervous, too, because you're right. I do worry about the bubble that we had back in the dot-com era. But, there is a little bit of something different this time around. With artificial intelligence, these companies are actually making money. It's not about .com, whatever your cool name was back then, 25 years ago, or it wasn't. It was about eyeballs way back then. But now, I mean, look at the money that things like Nvidia are making, or like today, like we had OpenAI and AMD get together. I mean, there are things happening there that do give me a little bit of comfort, thinking that maybe this all works out in the end as we grow into this new, say, transformative artificial intelligence, and it's another industrial revolution. Is that possible?
I think it's possible, but I don't think it's probable, because all bubbles look the same. They're just a little different. And the characteristics of this, when you look at some of the meme stocks that go up, I agree with you 100%. The big difference this time is there are real companies with balance sheets. However, when a bubble bursts, it doesn't matter if you're a great company or not a great company. You are going to be guilty by association, and your price of your stock, if you're in the most speculative area, will get hit hard. The difference is a lot of these names will survive, unlike the dot-com bubble, where a lot of them just disappeared. But I firmly believe, we've told clients, that this is a bubble. and it's going to get bigger and bigger. And when it pops, it will be very ugly. And this is why we pound the table on. We believe that a buy and hold strategy and blindly ignoring these risks that will ultimately happen will bite you in the rear end if you're not open to being very fast in making moves, because when it happens, it will happen fast. So again, we don't think this is a story that we have to worry about till maybe a year from now, but we continue to remind our clients that that is the reality of what we think this is going to do. Is this bubble is going to get bigger, but it is a bubble and it is going to pop.
I appreciate that, and that's some great stuff. In about 10 seconds, maybe a little bit longer, I mean, when you start to see the signs, do you go all cash or do you start to use other things to help protect your gains? What do you do?
Well, it's going to be interesting because normally gold is a very defensive play, right? That you would rotate more money into gold, utilities. Gold has been offense and defense. We've owned gold for a while now, and it's up another 40%. So we'll know when the market gets here. Our initial thought is we will rotate into defensive areas that generally do well in a risk-off environment. But if those don't work either, then the only other alternative would be to sit in cash. And I'd rather pay taxes on my gains than lose half of my portfolio.
And that's what we're going to end on that, because that's a good way to put it. Appreciate you coming on. It's what do they say, Eddie? A return of your capital rather than a return on your capital. That's what it's going to be.
That's right.
All right, Eddie, thanks for coming on the show. Eddie Ghabour coming to us from Key Advisors, Lewis, Delaware. Thanks for being on the show.